Well, good evening, everybody, to tonight's SALT Talks. Tonight, we're going to be talking to Greg Darling. He's with I put the link there in the chat box if you see it, but it's with the Disability Foundation. He's going to be talking to us about special needs trust. Now, I know, just like guardianship and just like all the other stuff we look at throughout the year, sometimes there's just a lot of questions, a lot of information that goes into each of these topics, and special needs trust is no different. There are so many, there's so much information. So we wanted to have a presentation tonight on the special needs trust, just to kind of help you get some clarity on what they are. I know we spoke about the stable account early, 2 weeks ago, and we had supported decision making last week. Next week, we're talking about guardianship, but the special needs trust, we just want to know how that works. I mean, there's going to come a time when we're not around for our kids, and we need to know what to do at that. I mean, we got to make that decision before that happens, before that time comes. But we want to know that they're secure, that we have things in place. And that's one of the challenges and the concerns I had, was just making sure after, I'm no longer here, family's no longer here, that that your son or daughter have that baseline or have that cushion to go to help with, because they might still get Social Security and they might have Medicaid or Medicare, but you want to make sure they have things in place that they can continue to live as they have been, that not a lot changes for them after something happens to you. But I want to go ahead and turn it over to Greg Darling. I have you set up as co-host so you can share your screen. And then as he's pulling everything up, you can put your questions in the chat box. All questions are welcome. I'll be watching the chat box and I'll let him know when a question comes up. And then we always allow, when the presentation's over, a few minutes at the end, I will stop the recording and we'll have an out and out discussion, or you can, unmute and talk at that point and ask questions if you're not comfortable asking questions during the presentation. So I'm going to hand it over to you, Greg.
Okay. Can you see my screen now?
Yes, I can see your screen. You're fine.
Well, I think, you've had an awful lot coming at you the last few weeks. It sounds like a lot more ahead. So I think if you get nothing else out of this evening, get my phone number. Because, we are certainly willing. Anytime you have a question, you're not sure what may work for you, whether it's a trust, stable, whatever, give us a call. We'd be glad to talk it through with you. It doesn't cost you anything. We're a nonprofit. We take our nonprofit status very seriously. We're part of the Dayton Foundation, associated with them. We are here to help. So, we want to try to help you. We are, just to explain a little bit, because there's often confusion about our role. We're a supporting organization of the Dayton Foundation, which means, yes, we're employees there. We're office there. They are our back office, but the Disability Foundation has its own nonprofit status. And what we do is we manage several pooled special needs trusts. That's what we do. So this is what you're going through now. I can, from Patty, this is the kind of things you're talking about. When you're doing estate planning, you're going to be talking about guardianship. That's wonderful. I guess you're going to have Brittany coming in a couple of weeks. She's on our board. She was our board chair for 9 years. She hired me. Excellent attorney and knows her stuff, nationally credentialed. So you'll get good information from her. But you also then realize special needs trusts are only a very small part of your estate planning, but very important. And so you're going to consider, depending on your resources, we'll talk a little bit more about that, but either a standalone special needs trust is crafted by an elder law attorney, such as Brittany, or another one, just for you, just for your family. You can join a pooled special needs trust, which is what we are. And then you're going to want to consider both first and third party trusts when you're doing that. We'll explain that. And of course, you want to look at stable. Stable is not our program, but it's a very valuable program for people who have children with disabilities. And we'll talk just briefly about that, because the two work well together. So framing all this, it's important that we understand why we need to do this. Why is it? Well, it's all based on needs-based benefits. On the left side, if you have worked, you're going to usually generally get Medicare, you're going to have Social Security benefits. Those benefits have nothing to do with what you've got in your bank account. You've earned those through your work. But Medicaid and supplemental security income both are limited in resources to $2,000. So it wasn't that long ago, it was until the mid 90s that an attorney would be telling you at this point that if before you die, you better disinherit your child because they're going to lose their Medicaid and their SSI benefits. That's no longer the case, but that's what you would have heard back then. Medicaid is the medical insurance, medical assistance that you need and people need if they're living with a disability. And supplemental security income, it's exactly what it says. It's supplementing your income. So if you don't have $967, the government will give you SSI and make up the difference between 967 and what you may have, what you don't have. So, and it's intended for shelter now. It says food there, but it's changed, thank goodness, as of last September. And the types of income that can reduce your SSI can be earned or unearned. Of course, wages is the obvious one for earned, but there's a lot of other things you can see on the screen that could be considered earned, or workshops, sheltered workshops, etc. All those things can be earned income. And if you have wages, if you get $100 a month, SSI is going to drop to $867. SSI is going to be the supplement. So these things reduce your SSI benefits. Unearned can be pensions, alimony dividends, but the big one is if you're living at home, so you're getting shelter paid by somebody else, that's going to reduce your SSI. Now, it isn't dollar for dollar. There's a formula Social Security uses, but it does reduce your SSI. Up until September 30th, any food, groceries also reduced your SSI, but that went away September 30th. Social Security removed that as an in-kind support and maintenance deduction. So that's where your SSI is at. And for some reason, here we go. We knew we'd have some problems, didn't we? Okay. Can you see it?
Yes, I can see it.
Okay. All right. Sorry, I don't know what happened. But again, this is the maximum SSI I was talking about. 967 for an individual, 1450. That's the maximum SSI benefit you can receive. Not a lot of money, as you well know. I always like to try to explain things by knowing a little bit about where we came from. So briefly, if you don't mind my giving you a little history here. So back in the 80s, this is when Congress actually could work together on some things. But they were very concerned. It was an emerging industry where you may recall it, that advisors, attorneys were telling people, here, give your money to your children and then become eligible for Medicaid. Well, wealthy people were doing that, and Congress was trying to get their heads around it. They didn't like it. They didn't think they should be doing it. And they kept trying to come up with ways of prohibiting that. They drafted very strict, severe penalties, all these kinds of things. The story goes that Henry Waxman, who was a congressman from California, was on an airplane and he was flying to Washington. He picked up a newspaper and it said one more scheme to get around the Medicaid rules. And he came back and he was angry. He threw his paper down and said, this stops now. We are going to stop this. So they came up with some very strict prohibitions. However, the Reconciliation Act of 1993 heard the advocates. The ARC was primarily leading it. saying, wait a minute, we understand what you're trying to do, but there are people that disabled folks that need their inheritances. They need the income they get. So they excluded them from the act by creating special needs trusts. That's when they were created, in actually 93. Ours was first created in 98. But they created two kinds of trusts, the D4A, which is the individual trust I was telling you about, and an elder law attorney, and some of you may have these trusts. An elder law attorney can give you that specially crafted individual special needs trust. They will tailor it to you and your family. They can put some bells and whistles on it. So it's like a trust protector and some other things they can do in that. The downside of that, though, is that to really make it financially feasible, you need to have substantial assets. And generally, I'm talking about several hundred to half a million, several $100,000 to $500,000 to make it financially feasible. You've got to also then find a trustee. This is someone who's knowledgeable about the laws and regulations to keep that trust from getting in trouble. You then take the money to a bank to invest it. And of course, you don't have leverage. It's just your money in that trust. So that's the downside of an individual trust. But they created pooled special needs trusts for everybody else. A pooled special needs trust is exactly what it says. It's one trust that people join. They become part of the trust. Um, in our case, we actually have three trusts, and we'll go through them. But this act again excluded the disabled by creating two different special needs trusts. And what it does, this is it. The money that sits in the special needs trust does not count as resources for Medicaid or SSI eligibility. So if someone is depending on Medicaid and SSI receives an inheritance, they can put that money into a trust and they still maintain their Medicaid insurance and their SSI eligibility. That's what it does. A pooled trust, like I said, is one trust that people join. In our trust, we have 974 members in our pooled trust across the state of Ohio. But the law specifically states it must be administered by a nonprofit association. So that elder law attorney that can do a standalone trust cannot create a pooled trust. That's why we work with a lot of attorneys like Brittany and other elder law attorneys. They may be serving the family in other legal matters, doing their estate planning for other things, guardianships. But when it comes time for the special needs trust, the family doesn't have the assets to support it. So they turn to us for a pooled trust. The pooled trust, this is all under the law. A separate account must be maintained for each beneficiary. Yes, it's pooled. The money's all together, but there must be a clear accounting for each separate account within that trust. The money that sits in the trust must be used solely for the benefit of the individual with disability. Money that sits in the trust cannot be used to give Christmas gifts. It can't be used to give the church. It has to be used specifically for that person. And if the money was their money, it came through Social Security, payback, or it comes through inheritance in their name, that means it's a first party trust. Then it must contain a Medicaid payback clause. You cannot get around that, except that it says the way the law reads is to the extent upon the death of the beneficiary, to the extent that money is not retained by the trust, then Medicaid must be repaid for all costs incurred on behalf of the beneficiary during their lifetime. Kicker is not retained by the trust. In our case, we retain automatically 25%. When the account is established, you can make it higher if you wish. That's not money to pay salaries or office space or anything else. What we do with it, and every pooled trust is a little different, what we do with it is we put it into a fund at the Dayton Foundation. We endow it, we grow it, And once a year, we have a grant cycle for nonprofit organizations that serve people with disabilities. That's where that money goes. But that becomes a very personal decision of the people establishing the trust, what they want to do with after 25%. Of course, to be eligible, you have to uh, be disabled. What's that mean? Well, I wear eyeglasses. I don't qualify as disabled under law. You have to meet the Social Security definition, which means you can't engage in substantial gainful activity. In 25, it means you earn less than 16.20 a month. And this is all because of a condition that could result in death or is expected to last at least 12 continuous months. That's the definition. And by the time people come to us for a trust, Social Security has already made that determination, because if they're receiving SSI or SSDI, that means they've been determined disabled. We don't have to ask questions about that. A caveat about pooled trusts. Another little bit of history here. When all that fighting was going on in the 80s about pools, about special needs trusts, etc., when they wrote the regulations, they, of course, created both the standalone and the pooled trust. The last draft, and you've heard of this kind of thing happening before, my understanding is the last draft didn't have a whole lot of time to review before it was acted on. The standalone trust specifically includes language that prohibits someone age 65 and older from either funding or establishing a special needs trust. You can't do it for a standalone trust. However, that language was left out of the language for the pooled trust. As a result, a pooled trust can be established for someone of any age. Now, this has been, as you would expect, debated a little bit. Some states prohibit it, about half and half right now. Ohio actually went a step further. In 16, they codified it to put in the Ohio Revised Code permitting it. So it's a little caveat of that. Sometimes, we have a case now where a fellow had a standalone trust. He got older and he still had money coming in. He had to put in a trust, so he created a pooled trust with us in addition, because he couldn't put it in his standalone trust. I want to explain what's a trust, because it's really kind of important to understand. It's really not a difficult concept, but it is a legal concept. So it's this relationship we're talking about, where one person holds title but has a legal obligation to keep it for the use of another. That's why I say when you have a trustee, they must know the law here. So in the case of a pooled trust, you get two trustees. You have the distribution trustee, in our case, it's us, and then you have an investment trustee, whoever holds the money. Both have a legal fiduciary responsibility to that beneficiary to use it for their benefit. The Disability Foundation administers 3 pooled trusts. If you know the Dayton Foundation, you can't be surprised that the first trust we established was an annuity trust. It's really, it functions much the same as a gift annuity. The way it works is you put whatever pot of money you want to put into this trust, and we compute a monthly annuity payment guaranteed for that beneficiary every month for the rest of their life. Whether it runs out of money or not, it's guaranteed they get it. But that money doesn't go to them. It goes into a spending portion, another portion of the trust, which means it's then available for their use. So every month, more money moves out of the trust into their spending account, available for them to take it for their use. The downside of this one is that generally a pooled trust, as you might expect, is not funded with a large sum of money, or people would be doing a standalone trust. Sometimes they do, but not always. So what that means is that annuity payment each month isn't going to be real high. It may be $100, maybe $50. So all that moves into the spending portion is available But if you need an adaptive wheelchair, Medicaid's not going to pay for it. That's going to cost you $1,500. That's going to take a while to build that up so you have that amount of money available. So in 2005, it was updated in 14. The foundation created the Pooled Flexible Spending Trust. This is also first party. It's also money that belonged to the beneficiary. In this case, same pot of money. Theoretically, if you had a need to use that fund day two, you could withdraw it and use it for that. It's all available within that trust. This one then has some investment value because the key bank, as the investment trustee, invests that money according to the conservative investment policy of the Dayton Foundation. So it grows a little bit depending on how much you take out, how much your fees and that kind of stuff. So, but it is much more flexible because you can use all the money you put into that trust and some growth as well. In 21, we created the third party pooled flexible spending trust. And this is, I hope you really pay attention to this in your estate planning. You heard me say in the first party trust, there's a Medicaid payback because that money belonged to the individual. A third party pooled flexible spending trust is money that never belonged to the individual. It comes by way of inheritance generally. And if the money in the inheritance, and we give people language with this, if it's written so the money is left directly to the trust for the benefit of the individual, as opposed to left directly to the individual, that means the money never passes through them. There is no Medicaid payback, which means if you have multiple children, if your disabled child should predecease other children, that money can go to the other children. It can go anywhere you want to. Family members, friends, charity, wherever you want to. There is no Medicaid payback on a third party trust. So it's something that really remember as you're going through your estate planning. And Brittany will talk more about that, I'm sure, in her guardianship too. So, as I said, you have two trustees with us. You have us as the distribution trustee. It's our legal responsibility to administer the trust. All activity works through us. You set it up with us. Distributions come to us to pay out. Deposits come through us. But then we move the money to Key Bank's pooled trust department up in Cleveland. They work with pooled trusts all across the country, have for many years, and they are the investment trustee. It is their legal fiduciary responsibility to account for that money, to essentially assign all investment activity, etc. You get a quarterly bank statement from Key Bank once a quarter. You'll see it, and it'll include all activity within that sub account, any money going in, any money coming out, any investment gained, any investment fees. It's all in that quarterly statement. They also, at the end of the taxable year, review the account to see if the IRS is looking for a K-1 form. That simply indicates the person had distributive income during the year and they have to issue a K-1. It's nothing to worry about because the income portion of that's generally 10 or 15 bucks, but it's a legal responsibility. And so Key Bank's the tax department does that. Again, those are our three options for our pooled trusts. So let's talk a little more about a first party trust. A first party trust can only be created by one of five entities with the assets belonging to the individual: a grandparent, a parent, guardian of estate, the court, or the individual themselves. Any of those five entities can create a special needs trust with the assets that belongs to the individual. Examples often include an inheritance that's coming in the name of the individual. It's money left to John, or a gift, a personal injury settlement. We serve people all ages, so we get a lot of personal injury claims and settlements coming to us. Any back payments from Social Security, accrued SSI payments, those are all monies coming in the name of that individual. It makes it a first party trust. And again, there has to be a Medicaid payback requirement written into the trust document. Third-party trust is similar, but it's created by someone other than the beneficiary. So anybody can create a third-party trust except that individual, the beneficiary, because they've got the money. It can't be created by them. But anybody can. We had interestingly enough, the first third-party trust we created was by someone, a neighbor that had a very close relationship with their neighbor, had a child who was disabled, and they created a third-party trust for that person as a gift. You can have multiple third-party trusts, but again, it's any money that has never belonged to an individual. And by the way, often the third-party trusts are created testamentary, which means that it's set there, it's ready to go, it's not funded till the person dies, and then it kicks in. And that's often the case with estates. Here it is, gifts, examples, gifts directly to the trust, inheritances, life insurance. Again, it all has to be directed to the trust. These are examples. I don't know if you can see this on your screen. These are just rough examples of how people use the trusts. Again, anything that is for their sole exclusive benefit, they can buy clothing, have hobbies, go out to eat, go to the movies, join a gym, subscriptions, cell phones, cable, anything that is for their sole benefit. The way it works is when you create a trust, you designate a personal representative. Generally, there's some exceptions, but this is how 90% of them work. You create a personal representative. That is the person who will access the trust on the beneficiary's behalf. They will work with us. Obviously, we can't give money directly to the beneficiary because then their resources are going to be too high, even if they can handle it. Even if they can handle money, the resources would be too high, and that makes them, that endangers their benefits. So we have to work with a rep. The rep can request money. We can send money, and they have to send us receipts. They can buy something, and we reimburse that rep with receipts. Or they can send us a bill to pay directly. Often that happens. That maybe someone's going to buy a computer from Best Buy. They give us the quote from Best Buy. Key Bank will cut a check payable to Best Buy. We send you the check. You take it to Best Buy. Any way that works. We also offer, well, we're going to come to that in a bit, and one other option. But anyways, that's how it works. What's the cost? With the Disability Foundation, we take the first $1,000 when a trust is funded one time. It's our setup fee. That's it. After that, once a year, we collect an annual administrative fee of $250 plus 0.25% of the market value of that account at the time we bill. $100,000 would be, I guess, $100. Anyways, 0.25% of the market value. That didn't right. Anyways, 0.25%. Key Bank, as the investment trustee, will also, of course, have some fees. They have an investment fee. It's only 60 basis points. It's 0.6%. That's an annual fee they break up through the year, but that's the investment fee. 0.6%. They have an annual fee of $50, and then they charge $25 once a year to do that tax lookup. But that's the fees. With all that, you put as much in as you want. You take it out as many times as you want. No more fees. That's it. So let's talk about Steve. I know you've had some presentation on that, and so I think we should talk about a little bit because these two work well together. Just a refresher, of course, stable is an investment account. It's not a trust. It's important to remember that whereas a trust, there is legal responsibility on the part of the trustees, the distribution trustee, the investment trustee. We have legal fiduciary responsibility. Stable account's like a savings account, but the accountability falls on the beneficiary. Not that that's to be worried about a whole lot, but the legal responsibility is not on Stable Ohio, it's on the beneficiary. As you know, Stable is done online. I don't know if you probably know this, but the disabling condition has to begin by age of 26. But in 2026, it goes up to 46. That's a game changer. A lot more people are going to be eligible for stable when that happens. And I don't know when it is. If it's January 1st, I'm not sure. Probably is, but in 26, that goes up to 46. Um, Stable, of course, has some limitations, as you know, 19,000 annually. Of course, that changes periodically. You can put in there. If you work, you get a little more. This is significant. Their uses are qualified disability expenses. There doesn't seem to be a whole lot of limit on this. And the big thing is housing. So if you have SSI benefits with a trust, I should clarify, you can, I want to go back a minute when I said sole benefits, sole use. Trust must be used for anything that's sole benefit individual, except anything medical that Medicaid would otherwise pay for. I didn't tell you that, but that makes sense. Secondly, if you have SSI benefits, you cannot use the trust for housing. That's a restriction of SSI, Social Security. However, stable does not have the same restriction. So what you can do is if you have to pay rent, then, and say you have, too much money for stable, say you've got an inheritance of $30,000, you set up a trust. As you need to pay your rent, we can move money electronically from the trust into your stable account and you pay your rent. A little tricky. You have to make sure you pay the rent the same month it moves in, but that's easily done. So they work well together. Also, the other thing that they work well with is sometimes people want to give the beneficiary a little walking around money. The TrueLink card that Stable has is kind of easy to do that, isn't it? So you can have the trust. We can move money, $100 into the Stable account. You give that card, and they have their, like I say, walking around money. But the most of that money is protected within the trust for the needs, the big needs they need. So just different ways people use it, but they do work well together. And of course, as you know, Stable costs you next to nothing to set up. Obviously, it's much more cost effective. And if you don't have a lot of resources, that's a better way to go because you don't want to pay our fees if you're not going to have a lot that needs to be protected. So, you've got Stable. It's not an investment account, but it's good for people. Don't have a lot of money. It works well. If you have a lot of money, you're under 65 years old, you can create a standalone trust. Some high fees, but it works well. They can craft it. But if you don't have anything in the middle, and this is going my history a little bit. I used to run developmental centers, and I can't tell you a number of times I'd go out and see someone getting a clipboard for a van. And so what are you doing? I have to go out and buy something for John. Well, what do you mean? If I don't buy something, he's going to lose his Medicaid. And I will tell you that too often, I think a lot of what they bought wound up in dumpsters because they just, a rash decision. But if you didn't fit if you have a lot of money for a standalone trust and you have too much for Stable, what are you going to do? Where you should consider a pooled trust in the middle because that will protect resources, make them eligible. You get trustees. You can use Stable as you need to. The other thing I want to tell you is I didn't put in here that we do offer a TrueLink card also, the same card that Stable offers. That becomes valuable in special situations. Realize that we serve people with all disabilities. So we have a fair group of people that can handle money, but not real well and need their benefits. Often it's folks dealing with a mental illness. And a lot of times people with mental illness don't have a lot of people around them that want to serve as a personal representative. We can give them that TrueLink debit card. The way it works, we control the card. It has their name on it. Looks like a Visa debit card. It's got their name on it, just like any other one. But we put the money in it. We load money onto the card, and we also load how it can be used for categories of expenditures. So they can be their own representative in those cases, um, because they can't turn that into cash. So that's another option that we can. So that's me. Like I say, write down that phone number, because if anything else you get out of this, give me a call. When you call that number for the foundation, you get me. Uh, we take our, like I say, we take our responsibility as a nonprofit very seriously. Um, we we are here to help people, and I will help people talk through it. Uh, Sometimes I say, you haven't got a lot of assets. You really want to think about doing stable. Um, Sometimes, you've got a lot. I said, you could do a lot with that. Why don't you talk to, here's a list of attorneys, see if you can create an individual trust. Realize we are not attorneys at the foundation. We have a board of governors of elder law attorneys. One of them's Brittany, and two other elder law attorneys in the area, plus other professionals, county board superintendents, financial people, etc., and advocates that serve on our board. We cannot give legal or tax advice. We can't do that. That's not our mission. But I'm certainly willing to help you talk you through it. There's no cost to do that. Just give me a call. Sometimes I go and have coffee with someone, and there's worse things in the world than having to sit down talk about this with someone over a cup of coffee. Yeah, so I mean that very sincerely. What
All
kind of
right.
question?
Okay, well, I am going to we'll close the recording so we can ask some questions, or people can maybe make a comment without being recorded, or if they don't want to type it. We didn't have anybody type anything in the chat box, so this will give them an opportunity without typing. But thank you, Mr. Darling, Greg Darling, for your presentation. And I'm going to go ahead and just close the recording at this time so we can ask some questions for a few minutes here. 1 second.